Good afternoon. Good afternoon. It's Monday, the 8th of April, and welcome to another edition of Market Mondays. My name is Tilan Wickramasinghe. I'm the head of research for Maybank Securities in Singapore. How far will the US rally go? I mean, that seems to be the question on everyone's mind. Oil is pushing $90 a barrel. We've got pretty resilient numbers still coming from the US. So the question is really whether the Fed needs to cut soon or whether the Fed really needs to cut deeply. So I think there's going to be a lot of uncertainty and caution around the markets, particularly in our region going forward. So it's actually very, very important that we remain very selective in the stocks that we buy. So that's what we're really going to focus on today on the show. We've got Jarek, who's coming on the line to talk about a very well-followed tech manufacturing stock that's completely missed the overall AI rally. He's upgraded the stock to a buy now, so we're going to find out why that is. And we're also going to talk about Opportunity Plus, which is one of our high conviction names, which has just doubled their order book. And now, whether is this still a buy or do we take profit from here? Jarek's going to be talking about that as well. Then we've got Anand, who's on the line. He's going to be talking about ESG. A lot of ESG flows haven't had a good time so far in 2022 as well as 2023. But Anand actually says now is the time to strike, particularly on his Malaysian ESG portfolio. So we'll talk to him about that. And then finally, we've got a technical buy as well as a technical sell coming up as well from Nick, our chart guy. So do stay till the end. Now, as usual, let's look at our market moves. If you haven't downloaded our weekly report, please do that from your app or from the QR code on the screen. Generally, US markets were quite positive last week. The Nasdaq up about 1.2%, S&P up about 1.1%, mostly supported by the US jobs numbers coming through. China was closed for 2 days, and we see that the market is opening down so far this week. Southeast Asia kind of rode the rally with the US. With the KLCI up about 0.1%, Jakarta up about 0.4%. The only outlier was Singapore, which was down about 0.5%, partly from weakness in the banks. Now, with that, let's talk about AEM. Now, Jarek's upgraded the stock to a buy with a target price of Sing dollars 278. Now, Jarek, the stock has been down by about a third in the past 3 months alone. Can you give us a quick recap as to why the market has been concerned so much about AEM and why it actually missed the whole AI rally?
Sure. I think firstly, I think there was this big saga on the inventory levels. So basically, they shifted some production from Singapore to Malaysia, and then they over-recorded their inventory by about 8 to 10%, and that's resulted some inventory to go overstated. So they had to do a write-down on inventory for the overstated inventory, which impacted market confidence on how can a company that's been listed so long make such a rookie mistake of overstating the inventory, right? So that is one. Secondly, I think the COO and the CFO have also resigned recently, which led to more speculation of whether is there any internal issues, that could happen that, could lead to these two key positions to departure. And thirdly, I think if you look at outlook in terms of revenue guidance, they have actually lowered their revenue guidance last year for this year. And that also impacted market confidence in terms of, whether is there any recovery even for AEM at all. So I think all these three factors are key of what caused the stock to actually took the plunge, in the last few months.
Right. But now you actually turned bullish on the stock. You've actually upgraded 2024 earnings by a big 50%. So what's driving your confidence now? Is all the bad news priced in?
Yes, okay. So for me, I think that, most of the I would say most or all of the bad news is priced in. I mean, going forward for the next 2 quarters for first Q and second Q, we do expect first Q and second Q to be very weak still. This has not changed, but we do expect second half to pick up quite strongly. So I mean, in the last 1-2 weeks, AEM announced that they have actually secured one of a high volume order for its automated burn-in solution by a major fabless provider of HPC and AI semicon chips, which we suspect to be Apple. This has not been confirmed by the company, but we suspect through our channel checks. And also, this order will come in the second half. So, in normal SGX rules, for you to announce a major order, it has to be, the guideline shows that it has to be 5%, at least 5% of revenue. So that's why I came up with this at least 5% of revenue that I expect, this order to come in. And if you look at AEM, they have another three customers they are working towards to ramp up orders. So we do think that, with this first order coming in, there's a good chance that the other three customers will also possibly ramp up orders in the next few months, which will help the second half earnings guidance. Going forward also, if you look at it, basically AEM, I think they actually kitchen sink and actually bottom sort of guided their revenue. So with this order, by right, second half revenue should be better. They should actually lift their guidance. And another key thing is that for Intel, their main customer, our channel checks from other manufacturers also show that Intel has actually provided a higher forecast for second half for many of these other suppliers for the second half. And we do think that for AEM wise, there's a good chance that actually Intel have also raised their forecast for AEM for the second half. But of course, AEM management wants to be prudent, and I think they only want to raise their revenue forecast only when they deem is very certain. So I do think that's why I do think that, if you look at it in the overall sense of things from the existing customer and the new customer, there's a very good chance that AEM will lift its second half forecast to something that's much more than what they are guiding for now. And we do think that, most of the bad news have already been priced in. This should be likely the bottom for AEM. That's why we upgraded the stock.
Right. So bad news priced in, a lot of the uncertainties, kitchen sink, particularly on the revenue side. Some of the main customers actually guiding for better sort of outlook going into the second half. So there is a lot more potential for the second half earnings to be upgraded as well. So all of that is really great, Jarek. But any sort of downside risks from here? I mean, given the fact that this company has surprised on the downside before, any potential negative news that we should be worried about?
Yes, I think the downside risk is more on towards the semicon recovery, whether will they actually come in the second half or be delayed further into next year, which is not just the downside risk for them, but downside risk across all the semicon related stocks. So I think that, as we are approaching the second half, we will have more clarity in terms of what kind of order recovery we can see. And the downside risk would be that, because currently the market is expecting a sort of a second half recovery at least. So if that doesn't come true, then potentially the stock could be hammered further, if they delay the recovery more into 2025.
Okay, so that's something to watch out for AEM, but also for generally the rest of the sector as well.
Yes.
Okay, so now let's move on to DYNA-MAC. I mean, oil is flirting around $90 a barrel. There's still continued uncertainty in the Middle East. The stock has been a fantastic performer. It's up, 30% in the last month alone. We have been highlighting this stock as an opportunity plus stock for some time now, Jarek. You think there is still more upside? They've just doubled their order book as well. How important is that?
Oh, it's very key. So basically, I think if you look at, previously we have mentioned in many of reports that they expanded capacity by close to 50 to 60%, and that will lead to more orders. And knowing the management, they are very prudent. They will only increase capacity if they know that there are orders coming. And I think that this contract sort of proves it that, that's why they did all the expansion that they did. And that's why they are so confident of more orders and larger orders. So if you look at the orders, the order book actually doubled, and not just the order book actually doubled, but this is the single that they won one of the contracts in the 456 million, which is the single largest contract ever, for DYNA-MAC's history, in terms of sizing, in terms of number of modules as well, which shows that, going forward, the contracts that the customer give them will likely increase because of the increased capacity that they have, which also shows the sort of market position that they have, that they are one of the first main players that the customer approach if they want to do any topside module. And also in terms of margins, they will actually be better because of the operating leverage that it has going forward as well. So we do think that this order is actually quite a record-changing order. It actually shows that the FPSO market is still very bullish. There's still a lot of construction of FPSO going on, and I think across the board, like Inson, all these are also saying the same thing, right? So that's why we remain bullish on DYNA-MAC that after this year, actually if you look, order book to 2025 has been already filled, and going forward the orders one will be larger. So we do expect earnings to actually potentially increase significantly over the next few years as well.
Right. So, I mean, I think the FPSO space is quite hot at the moment, given where oil prices are going and the massive underinvestment there is. So, how do you kind of see the overall FPSO space over the next couple of years, and how does that incrementally affect the order book for DYNA-MAC?
I think the FPSO, if you look at the FPSO charter rates, they are still rising even for this year. So for us, we do expect the FPSO space to continue to be strong, at least for the next 1 or 2 years, or maybe even 3 years. But for me, I'm looking more towards the next 1 or 2 years to be quite still very bullish. Going forward, FPSO rates are still likely continuing to increase because the banks are still not really funding this area significantly. I think one of the key things to look out for is if the banks started to fund this area significantly, there'll be a sharp spike. And then after that, maybe there might be a readjustment of supply and rates again downwards. But as of now, the banks are still not funding this aggressively. We do see the FPSO demand is still increasing. There has been a lack of FPSO actually. Oil price, the good oil price is still encouraging a lot of projects, exploration projects to continue. And if you look at even on the exploration side, they have been underexplored already actually in the last few years. So now it's just more of a catch up. Yeah, based on the demand for oil.
Okay, so a lot more potential for this to run. But as always, what can go wrong, Jerry?
I think what can go wrong would probably be more of like a recession globally that led to a drop in or a crash in oil price. I think that the oil price is helping sentiment, in terms of investments into all this space. But if the oil price starts to crash significantly, then you will start to see maybe some project delays or new project starts to slow down, in terms like this. So I think oil price would be one of the key major player. And also rather a recession or economic activity. But as long as the oil price stays above 60, actually is very profitable for all these FPSO players.
Okay, thanks, Jarek. Thanks for all those comments.
Cheers.
Now let's move from oil to green. Now the ESG space has been a very strong space. There's been a lot of interest over the past few years, but in the last 2 years, we've actually seen negative fund flows going into sustainable funds. Global sustainable fund flows have declined 2 years running going into 2023, but that's only part of the story. Sustainability funds as a share of global assets under management is actually still increasing, and global hard capex on net zero energy transition projects have actually hit a record of $1.8 trillion US. And Anand, you've just released a very comprehensive report on this. Why this dichotomy? Why is there so much new investments going in on hard capex, but why is also at the same time fund flows reducing to ESG?
Sure. Hi, morning, Dylan, and morning, everyone. And thanks for having me on the show. Maybe I can I share my screen in terms of the report itself?
Yeah, go ahead.
All right. Can you guys see this?
Yes, we can.
Okay, excellent. So it's a good question. When this is a 80+ page report, so I'm just going to nitpick a few charts here. But as you pointed out, Dylan, when you look at Figure 1, the last 2 years have been very bad for sustainable net funds or funds. The net inflows have been tapering off quite steadily, and in the fourth quarter of 2023, they turned negative. So, when you pair this with what you're seeing in the media, very dramatic headlines about EV growth slowing down, legal issues in the US. Tennessee just sued BlackRock a few months ago for misleading ESG strategies, and what's happening in the EU in terms of greenwashing and the regulatory uncertainties. It's easy to say, maybe green is slowing down dramatically, if not in retreat. But as you know, as I point out in this report, that's fund flows. Yeah, fund flows, markets go up and down, fund flows go in and out. But when you look at what corporates are actually doing, where they're actually spending their capital, it is an energy transition. So this is really a form of green hushing. Corporates not talking so loudly anymore about their ESG initiatives because it invites all sorts of comments and backlash from certain stakeholders, as we've seen in the US. But they're getting on with the job because it is the future. So when you look at this chart, figure 8 here, you'll see 1.8 trillion, another record. We've been setting consecutive records the last few years. And what's interesting here is, a lot of the new momentum is coming from fresh technologies that are being researched and funded, like hydrogen, as well as power grids. Power grids very important, primarily because you can have a lot of RE projects, but if they can't plug into the power grid, they're useless. Just sit there. So why the fund flows weak when the actual investments are strong? A couple of reasons. So, when you look at what's been happening the last 2 years in the world after the Ukraine-Russia conflict erupted, fossil fuels have really come back with a vengeance. And obviously, if you want to be positioned in fossil fuels, you're not going to find that exposure in sustainable funds. Yeah, so fossil fuel funds have done much better, or funds with exposure to fossil fuels have done much better over the last 2 years. And that's taken away from the attraction of being in a sustainable fund. We've also seen some other issues like many of the RE technologies, especially wind, have seen a big increase in costs due to supply chain issues, and that's taken away from their economics and their market performance as well. And of course, as I mentioned before, there has been a lot of legal issues in the US which have caused funds to pull back from this space. So it's a variety of issues. But given that one of the biggest sort of components of sustainability funds, which is tech. Tech is a extremely popular weighting in sustainability funds for obvious reasons. It's not dirty, it's not brown. That has started to perform in the last 8 months. And it looks like 2024 is going to be a fantastic year for tech as well. So I think as the fund performance recovers, you're going to see inflows reverse as well. And that's something that we'll look forward to in the next 12 months.
Right. So inflows will beget inflows. So I think that's something to watch out for, particularly in the tech sector. Now, you also highlight some key sustainability developments across the world in your report, particularly after COP28. What are some of the key issues that we should be aware of in ASEAN, where we play?
Yeah, I think COP28 itself, it's really more of a talk shop. Everyone gets together, comes up with statements. I think the big one this year was that the whole world now agrees to formally transition away from fossil fuels in a steady manner. So that was a key takeaway from the global stock take. But perhaps more relevant for ASEAN, given that we are more in the emerging market space, is how much support we will get from developed countries in our green ambitions. So that goes into things like the Loss and Damage Fund and the Climate Finance Target, which has a separate fund to help emerging markets green their economies. So that's good news and not so great news. The good news is the Loss and Damage Fund is actually been operationalized, but the amount is quite small. It's less than $1 billion. That's not really going to move the needle, but it's a start, and we expect that fund to build quite rapidly as more pledges come in. The bigger one, which will be formalized next year at COP29 in Azerbaijan, is the Climate Finance Target. So this is commitments in the billions by developed markets to help emerging markets reach their green targets. So that the funds in this particular pool in the billions, but we just need further finalization before it becomes more active. So I think when to conclude, when you look at ASEAN, every country has its own ESG initiatives. In this report, since I'm based in Malaysia, I focus on the Malaysian initiatives. But the point is to meet their NDC targets, many countries have two targets, one with foreign help and two without. And the ones with foreign help will tap into funds like this to get funding and expertise to execute. So very important that the COP annual meets continue to build support for this kind of funds for emerging markets like ASEAN.
Got it. And let's very quickly just talk about the ESG portfolio for Malaysia that you've put together. This has done particularly well over the past year or so, outperformed the MSCI Malaysia. What are your latest additions and deletions in this portfolio, Anand?
Sure. So we've been running an ESG portfolio for Malaysia since 2021, and we've had about 15 stocks in it. Once in a while we do change the composition. So in this round, compared to 6 months ago when we did our last update, we have done some changes. There are various filters that decide what stocks get included in this table. One is the stocks have to be rated buy or hold. So 2 stocks, Bursa and Petronas Chemicals, have been cut to sell. So we've taken those out. And we've added CTOS and Hartalega, which is a software company, and a rubber glove company, both buy rated, into the table. So we still have 15 stocks, just the composition has changed. How do we decide on those 2 stocks? Well, if you read the report and you look at figure 88, these are all the stocks that we in Malaysia have scored using our proprietary scoring model. And I'm sure in Singapore, Thilan, you flagged this to clients as well. And in Malaysia, we have about 87 out of 110 stocks already scored. And you can see near the top there, CTOS is one of the top scoring stocks, and Hartalega is not very far down the list either. So we really look at our own scoring in deciding how we populate this table. The good news, when we look at the performance, which is figure 87 here, even with the old portfolio with Bursa Petrochem and the new one with CTOS and Hartalega, you can see that the performance against the MSCI Malaysia is quite dramatic in terms of our performance. It's almost double digit over a 1 year, 3 year, 5 year time frame. So whether you believe in ESG or not, at least from this perspective, it does appear to pay to have ESG considerations in your portfolios when it comes at least to Malaysian coverage.
Brilliant. I think that's a key message, especially in this part of the region when you have to, especially when you're looking at this sort of volatility across the globe, be selective in stocks, and ESG is a very, very helpful screen to have when you're building your portfolios. Thanks for that, Anand. Thanks for joining us today. We are short of time, so we're going to quickly jump into technicals. We've got 2 stocks on the technical side. Nick can't join us today, but he's got KEPPEL DCREIT with a trading buy. He sees that the firm base since February should continue to see a recovery from here from stronger trading volumes. So that's something to watch out for. So do look at the more detailed explanation from Nick in our newsletter. He's also put a technical sell on RAFFLES Medical. The recent rebound attempt was capped by last week's selling pressure. Overall, the trend structure remains weak for RAFFLES Medical. So we expect the stock to trend lower going forward. Very quickly, we've got Chris Tan who's asking, if US rates stay high, what does that mean for the Singapore rates, and what does it mean for REITs and the banks as well? Our overall house view, Chris, very quickly, is that we don't see the MAS making any changes soon in terms of their appreciation stance of the Sing dollar, and also technically Singapore's interest rates mirror that of the US. So we expect rates to remain higher for longer, with cuts only coming through towards the latter part of this year. What does that mean? It generally means that overall margins for Singapore will remain relatively high, the net interest margins, but it will start to come off versus what they were in 2023, partly driven by funding costs. There is a little bit more tightness in the funding cost side. We will need to see whether the banks take an aggressive stance in cutting deposit rates and so on. We haven't seen that yet. UOB is a little bit on the margin, but we haven't seen mass cutting of deposit rates yet. So until that, I think for the banks overall, earnings would have peaked. But this does not mean that dividends will come off. We think that overall dividends for the Sing banks will remain very well supported, particularly for banks like DBS, which is our top pick. For the REITs, I think it's going to be a little bit more mixed until you start to see rates coming off, and the overall spread between the risk-free rates and the dividend yields. You will see some of these stocks trading sideways. So that's something to watch out for. With that, rates coming on, inflation coming out on the 23rd. Unemployment, these should be April dates and not March dates. We will fix that in our recording later on. And then in terms of upcoming events, we've got Electrifying the Nation Day for our Malaysia from Maybank Malaysia coming on the 18th of April. Again, these should be April dates and not March dates. And we have Invest Malaysia China conference coming out on the 23rd. Please do ask your sales people for registration. With that, we've run out of time. Thank you so much for joining us today. Have a profitable trading week and see you next week.